We're joined by Josh Mahony in London. He's Chief Market Analyst at Scope Markets. Hi there, Josh. Now, are we finally seeing some calm return to markets following last week's rollercoaster, especially for tech stocks?
Yeah, definitely. I mean, certainly the beginning of the week started with the huge volatility around precious metals. Then we rotated into all these fears around tech, in particular about how Anthropic's plugins are essentially a sign that all the software businesses may as well just pack up shop, because soon they'll all be replaced by AI tools that will be a fraction of the price. Well, I think a little bit of time has passed since then, and people are starting to realize that maybe this is oversold to a great degree. And maybe these companies, in actual fact, will probably utilize AI to be able to create new iterations of their products at a cheaper price, and will probably still maintain a strong position within the market. So people are buying the dip. And what's notable here is we've already got the Dow at record highs, the S&P 500 not far from it. And now with the tech companies coming back into play, this period in actual fact has provided a nice broadening within the market as people start to spread their investments across the board rather than relying on tech. But that doesn't mean that the tech rally is over. So with them coming back into play, the US markets appear to be in a much more healthy position.
Looking at the pullback in gold, is that simply a breather as we wait for those jobs and inflation data out in the US?
Yeah, I mean, when we're talking about being in a healthy position, I think that the gains that we've seen, in particular for silver, just look like something that couldn't last forever. And so if you look from a long-term trajectory, at some points you will see these pullbacks, and that's exactly what we have been seeing for gold. There have been some question marks about whether the new Fed chair is going to be good or bad for gold, because he wants to shrink the balance sheet. So perhaps that might undermine some of the arguments for gold. But in the day and age of Donald Trump, I think we're going to continue to see question marks on a geopolitical spectrum. We're going to continue to see countries ramping up debt. Of course, we're looking at Japan this weekend with the election result. And therefore, I expect to see more of the same. But yeah, we're going to see a little bit more of a cool market, a gradual climb, I would hope, rather than the kind of sharp moves that then ultimately saw this big pullback recently.
And what cues could the data provide for the Federal Reserve's trajectory going forward?
Yeah, well, what's notable is that last week it was all about how Kevin Warsh was a major hawk. That means he's not going to cut rates. It means he wants to shrink the balance sheet. In actual fact, if you were to think about it, how is Donald Trump going to spend that amount of time trying to decide who's going to be the Fed chair and accidentally picking someone that isn't going to do exactly what he wants? So he will want to cut rates, but he needs the reasoning for that. And in the past, he has been very hesitant because of inflation. So if we do see inflation remain under control, and particularly if we see weakness for the jobs market on Wednesday, then that provides the basis for him, traditionally a hawk, to be able to then start to approach Fed members when he comes into power at the beginning of the second half of the year, essentially, which is the first Fed meeting after May, and be able to say, look, we need to put the foot on the gas. In particular, he believes AI is disinflationary, so that provides another reasoning for him to say, never mind about the inflation, it's time for us to really start to boost this economy.
All right, Josh Mahony in London, thank you very much for that analysis.